I'm Kärt when I'm in Estonia, and I am here to lift you out of the misery for the next 20 minutes. This misery of bank runs and flat growth, and no one seems to be investing in anything anymore because the world is suddenly a very, very scary place. But for the next 20 minutes, we're going to fast forward 6 to 10 years, depending on where you are now, whether you're pre-seed or Series A already. And we're going to talk about the world where the IPO windows are open again, the acquirors have deep pockets and want to invest in innovation again, and the world where you have your billion-dollar valuation, the unicorn status that Tavi was talking about. But in order to get to that world, there are milestones along the way. And even though it's true that right now you should be focusing on just those milestones that you promised to your last round investor for the next 24 months, and you should be executing on those, it is good to be aware of and communicate to your team, to your investors, to yourselves, the milestones that are going to get you to the billion. Because what those companies that reach a billion-dollar valuation have in common is that they are very, very good at communicating bigger than they are at the current status. And the reason that I'm able to talk about those late stage parts of this journey that some of you have started, some of you are thinking about starting, and that ends in about 10 years' time, is because I've made, over the last 8-9 years, 13 direct investments in European companies, and of those, 7 have turned into unicorns, so billion-dollar plus valuations. One of them we invested at the billion-dollar mark, so they didn't necessarily turn into a unicorn, they were already there. And obviously, doing the math, 5 of them haven't reached there yet, and I'm going to talk about that as well, because it's also good to know about obstacles and challenges, just as well as opportunities and milestones. But starting from the one that we invested in first, and that I want to talk about the least, because I think everyone in this room is familiar with the story, but they are the best at this communicating, being bigger than they really were at every stage along the way, is obviously our very own TransferWise. We invested when they were only about 5 million of revenue. They were, in that sense, the smallest one in our portfolio, but they could really make it look like they were a 20 million revenue company, a 40 million revenue company, because they had done their research in terms of what are investors looking for in a company by the end of the journey. And the other companies in our portfolio as well, they made the same transformation from sort of being focused on the product only to being focused on the markets, from having these super fans as customers that Tavi was talking about, to having customers who need the product to be available in 5 seconds or they're going to go away because there's, again, 20, 40 million worth of them now, and they can't all be super fans. So what are the sort of categories of change that happen along the journey? When you start, you look at hyper-growth. You look at a company changing in the first years 5 times, 10 times in the course of a year, and then that growth curve flattens to about 2 times in the sort of Series A to Series B to Series C. Then it's good if you grow 50% from Series C to Series D. But what is important for the investors is that along that journey, we start looking down from the revenue line. Pre-seed, there's no revenue to look at yet, there is just product. Seed, there is some revenue, and any sort of indication of revenue is great. Series A, we look at product market fit, so we really look at sustainability signs emerging in revenue. And from Series A onwards, we start looking further down the income statement. We start looking at net sales instead of just gross sales. We start taking apart that revenue figure and asking, what is recurring? Where does it come from? How much of that is the same from quarter to quarter? How many of those quarters can you predictably forecast? And how sustainable is it? Because from this early stage, crazy courage and change, by Series B, Series C, you need to emerge in a more safe, predictable, sustainable way. And that is usually a fairly difficult transition to make if you're not aware that the investors are looking for it. Because in the early days, you're encouraged to be stubborn, to force your vision through, to be the one that knows the market the best, because you have the ownership of this company and you're the one person that knows the client the best. And yet, 6 years later, Series B, you are ahead of a complicated organization where you're a minority owner and you're encouraged to listen, to be part of a team, to take a bit of a backseat, but at the same time still drive your vision to the exit. And that's a mentally very challenging transformation to make. And again, coming back, what it means is a journey from creative chaos to relative safety and predictability. And safety and predictability in the minds of investors ends with profitability. And the best startups are those who are always the right amount of time and capital away from profitability, which means that depending on the exit you want, if you want an IPO, and in our portfolio, we unfortunately have an example as well that was a $1 billion exit that then after IPO pretty quickly turned back into a 300 million valuation at which we invested. And the reason for that was that they were not ready to IPO. They were convinced to IPO by a SPAC. That disease has hopefully passed like the pandemic, and companies are no longer encouraged to go public too early. But the problem was that they were at the wrong point in their journey down their income statement. They did not have profitability in sight. They did not have control over their finances, which, for example, again, coming back to TransferWise, they had it perfectly under control. They were able to spend exactly as much as they wanted rather than what they were forced to spend. And that is what public markets are looking for. Either already existing profitability or a very, very controlled path to profitability in a short time window. M&A acquirers who acquire either for technology or for data or for customer base are much more forgiving. So in order to know where you need to be on your path to valuations and on your path to exits, you need to also know what type of an exit you are preparing for. And you can play those exits against each other. So for example, in our portfolio, we had a company called iZettle. They capitalized on European technological edge. They did bank card readers initially that were just better than the American ones because the European banking system was more technologically advanced at that point. By the time they exited, they had turned into a data company, and that is one of the growth opportunities they were able to project for the investors along the line. That was the milestone that they met consistently in Series B and Series C, sort of transforming something single product, hardware related, fairly limited, dependent on one type of customer story into multi-product, independent of any device or service data product that was very attractive to acquirers. And the way they managed the exit was that they knew that PayPal wanted them for the technology and for the customer base, but they also knew that PayPal felt like they were able to wait to see more of those milestones hit, and they effectively threatened with an IPO. They became an IPO-ready company with the path to profitability that I talked about that comes with it, in order to force an investor who actually did not need that profitability into writing the check, because IPO is a very effective threatening tool because there is no point of no return. So they were 24 hours away from submitting the IPO prospectus and putting the shares on the market, from which it would have been very difficult for PayPal to get those shares back, into a very successful negotiation with PayPal within those 24 hours for twice the price that they would have listed at. So, and again, they displayed the understanding of what different types of investors are looking for in terms of both the path to profitability and the need to acquire technology and databases, and they managed to play those against each other very successfully. So, as I said, if your goal is IPO, you need to get to a path of profitability very fast. By the time you're thinking of listing, that bottom line needs to be there. If you're thinking about staying private for longer, being acquired in an M&A process, then you can sort of stop in the middle of that income statement. By Series B, Series C, Series D, you do need to make sure that your unit economics profitable, and that is something that a lot of investors forgot in the years of 2020, 2021. We, again, looked at the very top line only, but by now we have remembered, and we look at how profitable is each of your customers. And it used to be something that only SaaS companies and SaaS investors talked about. So what is your customer acquisition cost? What is your lifetime value? Is it 5 times higher than, is one 5 times higher than the other? Is there a potential for one to grow to be 20 times higher than the other? And now this is being asked of every company in whatever field you are, and we realize that it's much more difficult for a B2B company to calculate what costs go into acquiring each and every single customer, because those customers are very different from each other, and those costs are spread across sales and marketing teams. But we are now living in a reality where you do need to get those metrics under control. And again, you don't need to know them right now if you're a pre-seed or a seed company and you don't even really know who your customers are going to be. But at the back of your mind, you need to have an awareness that a few years down the line, someone is going to ask you for these, and therefore at some point, you need to start presenting awareness that you are going to get there, you are going to measure these things, you have an idea of what they start look like, and that is how you make your company look bigger than it is. So this is the journey from sort of top of the income statement towards either middle, where you're still unprofitable as a company, but you're profitable on a per client level, and this is where you can stay private, raise later stage rounds, and get acquired in an M&A transaction, or if at that point you decide that your journey is to be a public company, not owned by anyone, independent with the same founder, staying in charge of a company. Like, for example, one of our portfolio companies, Verif, they are the kind of company who, if they were acquired by someone, that would probably hamper their ability to do what they're doing, which is trust and identity verification. So that is better as an independent company. So at some point, they probably mentally need to make the switch, thinking about IPO, thinking about profitability. The other journey, as I mentioned, is from dependence to independence. So safety in hedging. You want to start with clients who are concentrated, who are similar to each other, because then you can focus. But it means that you are dependent on one client group or a single client. If you're B2B, you're dependent on a single market, on a single channel. And then again, somewhere along the line, around Series B, Series C, you need to start to switch your focus, mentally switch from being concentrated and knowing very well each one of your customers, your markets, your channels into diversification and being more open, being more familiar and comfortable with uncertainty, but again, being able to communicate that in a positive way into safety in numbers, into diversification, into future growth opportunities that are not limited to any single thing. That is what you're focusing on in the beginning. So these are the sort of general rules of thumb about your financials and the journey of how it changes from pre-seed to Series B, Series C, and how the focus changes from being focused on single products, single clients, to being diversified, being safer in the eyes of the clients. And the way this gets financed by investors is that in the beginning, it feels like there is a lot of possibilities, a lot of uncertainty. You have freedom to pivot, you are being given capital for experiments, and it feels like the possibilities are endless. The truth is, investors are limited in what they can do. Their own funds are 10 years long, so by the time their funds end, you need to have arrived at the exit. And that means that you need to grow to a certain level in order to return the fund or return a sufficient multiple to the investors. So from Series A onwards, those paths narrow very much, and suddenly there are revenue multiples that are being put in place. Suddenly there is a limited amount of dilution that you are allowed, because we need the founders to still be incentivized by the exit. So suddenly the world narrows into sort of 10 million at Series A, 20 million at Series B, 40 million at Series C, and there is very little variability around that. Because again, we need those amounts of capital to reach the next milestones, and the revenue multiples, which used to be sort of 10 times in 2020 and 2021, they are reverting back to the mean of 6x. So every dollar raised used to mean $1 of revenue, and it needed to last you for the next 2 years while expecting a revenue growth of 2 times between Series A, Series B, Series C, and then sort of mellowing down to Series D, which roughly meant that you could raise a quarter of your revenues today. And that has become tighter. You are now raising maybe 1/8 of your revenues, and you're still expected to hit the same revenue targets, because 100 million may no longer mean a unicorn. We may now be expecting 150 million. So on the way, even though you're given less capital, you're actually expected to do the same amount of work or even more. So the narrowing of possibilities means that Series A is an inflection point. It's where we start to look from MRR, sort of things changing monthly, to ARR. We start looking from sort of what do you promise to do to what have you delivered, because a lot of the journey has already been walked, and therefore plans change into execution. And sort of we start looking from what you did in the last month and extrapolating it for the next 5 years into actually what can we sustainably predict for the next year. So from Series A onward, we actually look at financial year +1, but it's punishing, because if your growth rate for the previous year has not been 100% plus, then we extrapolate that growth into the future, and we put you on a lower growth path. So really, you need to be aware that from the endless world of possibilities, it is only really around 4 to 5 years, maybe 6 if you're a deep tech company, because those take longer, that you're given to play around and pivot, and from then onwards, the path narrows, and you need to be on a specific growth curve if you want to get to a unicorn. And I'm going to open it up to questions in a minute. But just one final thought that I wanted to leave you with is that those milestones that I talked about, the 10 million of revenue for Series A, 20 million for Series B, 40 for Series C, those apply to only 89% of founders. And I hope that the people in the room are starting to get aware of what this 89% signifies. So this is the percentage of founders who raised capital last year in Europe who have all male founding teams. For them, these milestones apply. For teams who received 11% of capital in Europe last year, which have at least one female founder, those milestones are double. Female founder startups produce twice the revenues for VC investors, which means they need to produce twice the amount of revenue in order to get funded. So when you're on your journey and you're meeting these milestones that I talked about, and you get funded and you raise your capital, and you're rightfully proud of yourself because it is a huge accomplishment and it is difficult, then I'm asking you to spare a thought to the founders who are asked to do double and try to help them if you can. Thank you.
Thank you very much. There's a lot of fascinating ideas in there, and I do admit I'm not the expert in this area, so I have some interesting questions for you. Which I just closed the question page. Very clever of me, very smart, but I wanted to ask about you. When you are a young startup founder, as we might say, there's a lot of people in this room, can you talk exit too early?
Yes and no. It depends on how you talk about it.
Okay.
You should talk about it the way I've talked about it now, as in something that is uncertain and in the future. So you obviously cannot make any promises. You cannot say, you know, we will definitely be acquired by Facebook in 10 years' time. But what you can say is we are working towards something like that. We have an ambition to be a billion-dollar company and be acquired, because from that, an investor understands that your incentives are aligned, your ambitions are aligned.
Okay, that makes sense. So it's not, okay, to be realistic,
yeah.
Humble, hey, this is something we've thought of, but look, we get where we're at. We're not like crazy people thinking over the top.
Exactly.
Can you dig in a little further? You made note at the start of the talk about how when you first saw TransferWise, never say the T word around them anymore, it's wise these days, they seemed bigger than they were. It's almost like a young person is more mature than they seem if you see a teenager or something. Can you describe that a little bit more? I couldn't quite get what you saw in it.
Yeah, no, and I mean, their founding team also was incredibly mature, right? Because at that point in their life, they already had incredible experiences in the right field, and that allowed them to be that. But what I would say is they had done their homework. They had talked to later stage investors than they were currently raising, and they had understood the picture that they were expected to present 2 years down the line, 4 years down the line, and they kind of borrowed from that future picture to describe themselves the way they were at that point, and that made them sound incredibly mature and incredibly in control of their journey.
So is that like going to more experienced or investors that you're hoping to meet down the road and saying, guys, I know we're not ready to meet yet. I know we're not ready to do this, but I just want to talk with you, find out a bit more so I can start to work to that already. It's that.
Exactly. That is exactly what I mean.
Okay, interesting. So doing that. Again, this is not my direct experience, but I had a friend of mine who runs a fairly large consulting company across a number of countries. And I was with him, I was employee number 5, and now he was writing to me the other day saying that they're preparing for an IPO, and that involves financial accounting, and there's a whole bunch of stuff, and it's quite costly to get your company in order. And I said, you know, Rob, are you going for the IPO? And he's like, I'm not sure. But by doing this process, it's just a good process. Mm-hmm. You know, it's a good health checkup. It's a good thing to have. Are you seeing something of that? Like, we'll do that almost up until we sign the signature.
Yeah. I mean, again, most companies don't do it as extreme as iSettle did, like really to get the prospectus ready and be 24 hours from pushing the button on the stock exchange, because that whole process is expensive. But I agree that it is a good health check in a sense that if you can afford it, it puts your company into a very good framework, into a very good state of mind to be acquired. So to a point, yes, it's a good process.
Right, so in your friend's example, right, there was a real deal on the table, where in other examples, it's just maybe, because my friend always had this analogy. He's like, I want to be the hot girl at the prom that everyone comes and asks out for a date, but I'm never going to accept their date. And I guess that philosophy has stayed the same way. By doing that little bit expensive process, he's making himself even more attractive to potentially, he'll probably still say no to them in the end, but that's what he likes doing.
But exactly.
All right, Kart, thank you very much for your time. One more round of applause for Kärt Siilats.